on America's war in Afghanistan. The previous year, we talked about the war on terrorism. The year before that, it was American policy toward the Middle East. So this year, in the backdrop of the Great Recession, the worst financial crisis since the Great Depression, we decided to turn our attention instead to international economics, and specifically to the topic of international monetary policy. So I think we're in for a particular treat today. The book that we're going to be discussing, Exorbitant Privilege, The Rise and Fall of the Dollar and the Future of the International Monetary System, is a wonderfully lucid and intelligent study of the history, role, and future of the dollar as a global currency. It is by an outstanding specialist in public policy, economics, and international financial politics, Barry Eichengreen. The book not only details how and why the dollar became a global currency, but also explains the quite significant advantages that accrue to the United States as a result of having the privilege of the dollar as the foremost international currency, the challenges that are now there to that role, and the likely scenarios that will emerge out of those challenges and their consequences for the American economy, for American trade, and for America's geopolitical position in the world. So we're extraordinarily fortunate to have Professor Eichengreen here today to talk about his book. Barry Eichengreen is the George C. Pardee and Helen N. Pardee Professor of Economics and Professor of Political Science at the University of California, Berkeley. He's currently president of the American Economic History Association. He's served as a senior policy advisor for the International Monetary Fund. He is a prolific commentator on international monetary and financial systems, both in the United States and abroad. He is the author of many books. I'll just name a few of the titles here: Emerging Giants, China and India in the World Economy, Labor in the Era of Globalization, Fostering Monetary and Financial Cooperation in East Asia, The European Economy Since 1945, Global Imbalances and the Lessons of Bretton Woods, and Financial Crises and What to Do About Them. So this new book that we're talking about today, Exorbitant Privilege, is hot off the press, literally was published in December by Oxford University Press. I should mention that after the forum, we will have a book signing ceremony and reception outside. You're welcome to join us and to purchase the book there as well. So we have a stellar panel of experts to comment on this book. So as you could tell from Professor Eichengreen's biography, he is a part economist, part historian, part political scientist, and we have one of each to comment on the different aspects of his book. So, in fact, this is precisely the kind of interdisciplinary interaction that Pierce, Princeton Institute for International and Regional Studies, tries to foster. That is to get people across these traditional boundaries to talk about an issue of common interest. So Harold James, who's our historian, is Professor of History and International Affairs at Princeton, Director of Princeton's Program in Contemporary European Politics and Society. He is a prolific author as well, a leading specialist in German, European, and international economic history. Among the many things that Harold does, he is a renowned specialist on international financial institutions. Among his many books are International Monetary Cooperation Since Bretton Woods, The End of Globalization, Lessons from the Great Depression, International Financial History in the 20th Century, The Roman Predicament, How the Rules of International Order Create the Politics of Empire, and the Creation and Destruction of Value, the Globalization Cycle. Our economist is Hyun Shin, the Hughes-Rogers Professor of Economics at Princeton, a well-known specialist on financial economics with particular reference to financial institutions, disclosures, risk, and financial stability. His recent work has focused in particular on financial bubbles and crises. Before coming to Princeton in 2006, he was professor of finance at London School of Economics. He served as advisor to a number of central banks and policy organizations on issues of financial stability, and is the author of many, many articles and papers, as well as 2 books, Risk and Liquidity, and the Squam Lake Report, Fixing the Financial System. Our political scientist is John Ikenberry, the Albert G. Milbank Professor of Politics and International Affairs at Princeton. He also is the co-director of the Center for International Security Studies at Princeton. He is one of the country's top experts on U.S. foreign policy. John was co-director of the Princeton Project on National Security that examined the changing character of American international security environment. He's also author of many, many works in the area of international security. Again, just to cite a few, State Power and World Markets, After Victory, Institutions, Strategic Restraint, and the Rebuilding of Order After Major Wars, Power in the World Economy, Liberal Order and Imperial Ambitions, Essays on American Power and International Order, and his forthcoming Liberal Leviathan, The Origins, Triumph, Crises, and Transformation of the American World Order. So the way we're going to proceed here is that each of our commentators will start with comments on the book, about 10 to 12 minutes, and then we will have Professor Eichengreen respond, and then we'll open it up to questions from the floor. So we will start, as we should, with history with Harold James.
Thanks, Mark. It's an enormous pleasure to be here and to be able to think about this really wonderful book that Barry Eichengreen has just written, and that is really extremely topical. I think it couldn't have come out at a more appropriate moment. I mean, its message was really pretty quickly endorsed when President Hu Jintao came for his visit to Washington and began with a press interview about the US dollar and the way that the dollar-based international system was, as he put it, a thing of the past. He was really taking a leaf exactly out of Professor Eichengreen's book. There are really two parts of this book that I think are worth discussing in equal measure. One of them is a relatively benign message, a relatively benign part of the book, that thinks about a world in which there are a multiplicity of currencies as being something that's quite natural, that the world of the 19th century was like this, the world in the 1920s was like that, and that's interesting for an economic historian. That's really a new way of looking at the 1920s, and I think a correct way of looking at the 1920s, and that the world of the future could be like this as well. In other words, that it isn't really natural or inevitable for there to be a single currency around which the rest of the world has to revolve. But there's also a second part of the story that Professor Eichengreen tells, which is much scarier. And I think that probably will get more of the attention in discussions of the book. That's above all in Chapter 7, which is about the possibility of a dollar collapse, of something really abruptly catastrophic happening and changing with a bang the way in which the world looks. Now, that part of the scenario seems to me to be plausible as well, in that the world doesn't really move in simple, smooth transitions, but the transitions from one phase to another are often marked by really profound breaks and crises, in the same way as when tectonic plates move, they build up pressure, and then when they really move violently, there's a big earthquake. And I suppose it's appropriate that a professor from Berkeley should talk about things in this kind of way. So the last chapter of the book is concerned with the possibility of a violent shift. It could be for an external political reason, and there's a nice analysis of something that also looks very topical today, the 1956 Suez episode, when the British currency came under a profound and sustained attack, and in a way it was the episode that marked the end of the long transition from Britain as the central part of the international economy to the world in which the United States would play the preeminent role. And the financial attack on the pound in the wake of a falling out between Britain and the United States about how to deal with President Nasser's nationalization of the Suez Canal was the episode on which this occurred. And thinking of the future, it's easy, I think, to imagine situations in which there's a clash of interests between China and the United States, and in which China could use its big holdings of dollars in a way that the United States used its position in the 1950s in order to exercise leverage over the British and over Prime Minister Anthony Eden. And the second way in which this kind of crisis can come about is as a result of something just bad going wrong inside the economy. And that, I think, is also a plausible and indeed actually quite likely prediction about the future. And the book examines in particular the build-up of the fiscal debt and the probability that at one stage the foreign holders of the debt will think that enough is enough and won't be prepared to lend on the favorable terms that they had in the past. And in a sense, that really constitutes the Exorbitant Privilege that is the title of the book and is taken from the French attacks in the 1960s on the position of the US dollar when France was worried about the sustainability of the dollar in the international order. Now, there are historical precedents for that kind of collapse, just as there are historical precedents for the kind of 1956 dispute in which a foreign policy incident might trigger the end of the dollar. There are relatively mild versions of this, and there are quite severe ones. If you want a really, really severe example, in the early 1920s, after the First World War and after all the losses of the First World War, there were big, big capital inflows into Germany, and they allowed Germany to keep its head above water for a substantial period of time. But then in the summer of 1922, the domestic political situation in Germany deteriorated. The foreign minister was assassinated by nationalist thugs the day after the leader of the opposition had delivered a viciously polemical attack on him in the parliament. And that was the moment after the assassination of Walter Rathenau that the foreign creditors lost confidence in Germany, and what had been a relatively restrained inflation turned into a hyperinflation. Foreigners were no longer willing to carry the German debt. That would be an extreme example of something really, really unpleasant happening. But there's a milder version, actually, that occurs in relation to the US dollar in the late 1970s, when, again, there are worries about the geopolitics of it. There's the Iranian Revolution. The world is under shock. And the United States, for the first time, borrowed from the IMF, issued bonds in foreign currencies. And that was a case, I think, in which a crisis actually prompted quite a valuable bit of rethinking, and monetary policy changed, and the outcome of it was not really catastrophic in the end to the position of the United States at all. So a dollar crisis could come in a mild form as well as in a very violent form. But I thought also one of the interesting alternatives that is sketched out, is it conceivable that other currencies might take the place of the dollar? And there, I find it difficult to be really confident about any of the currencies that are currently on offer, as it were, as would-be successors to the dollar. If we think of the countries, the big industrial currencies, we could think of the Japanese yen, the strongest performing international currency of 2010, but Japan has an enormous fiscal debt, mostly internally held, but if there's a big increase in world interest rates, it's easy to think of circumstances in which that debt would be pretty quickly unsustainable. Is it possible to think of the euro as a successor to the dollar? There's a powerful and interesting chapter on the euro, and the euro is a very, very interesting experiment in the deliberate creation of a non-state currency. But there are clearly, at the moment that Barry was writing the book and at the moment that the book was published, also considerable doubts about the capacity of European countries to respond to the fiscal issues raised in the aftermath of the financial crisis. So this again looked to me more like the world of the 1960s when people also began, that's the period when the exorbitant privilege phrase comes up, began to worry about the position of the dollar in the world. And they looked at the dollar and the other leading reserve currency at the time, the British pound, and thought of them as lame ducks propping each other up. And that seems to me to be not a bad way of thinking about the major industrial currencies today, that the euro and the dollar and the yen all have weaknesses, but there are different kinds of weaknesses. But in all, it doesn't make for a very convincing system. And that goes, I think, for the alternatives that Professor Eichengreen discusses when he thinks of whether it's possible for a composite currency like the SDR to succeed the dollar. A composite currency would be great if all the members of that composite currency were relatively stable, but if they're going to fluctuate wildly, there are also going to be problems with the composite currency, and the Europeans actually have some experience in this, in the sense that before the euro was drawn up, there was the ECU, the European Currency Unit, which looked very promising as an investment currency, but in the big crises of the European monetary system, when the currency started to move in the early 90s, it lost massively in popularity as an investment currency. So the alternatives are really, I think, worrying. That there's not a clear, obvious successor of the dollar. Whether the renminbi will be in the future a possible successor of the dollar is also a question that's addressed in the book, but that's clearly not something that's going to happen in the immediate future. And that prompted me to think of a final question. Could it be that this is really the beginning of a transition, not from the dollar to another currency, but from the dollar to some completely different approach to managing money, in the sense that we've had these transitions in the past? We had a world that was based on the gold standard in the 19th century. We had a world that was based on paper currencies, fiat currencies in the 20th century. We thought that we'd got a very good grip on how to manage a fiat currency, particularly over the last 2 decades, that we got stable rates of inflation, good monetary policy. But that achievement is really beginning to be questioned in the wake of the financial crisis, and I think remains as a question. The second question is, I think, also relevant here. This is a world where reserve currencies matter in the historical account that Barry Eichengreen gives. But reserve currencies and the demand for reserves are a particular phase in a historical development. And it could be that as economies mature, they need less and less reserves, in the sense the United States today doesn't need very much in the way of reserves. The Europeans don't need very much in the way of reserves as the rest of the world matures. Maybe this debate about reserve currencies is also a thing of the past, fading like the dollar itself. Thank you.
Okay, we'll hear next from Hyun Shin.
I've actually prepared some slides for this presentation because I wanted to show you a couple of graphs. I had a preview of Barry's thesis, his book, a few months ago. But reading his book, I realized it's only the final chapter that he was speaking about. And the whole discussion leading up to the final chapter is really very rich with a lot of interesting historical detail. There were lots of facts that I hadn't quite grasped, but now it all makes sense. He brings it all together. What I want to do is to focus on one thing that Barry didn't say in the book, and try and sort of gather together some of the strands with what Harold was talking about. Barry's book is really focusing on the first two of these bullet points. It's about the currency that's used to settle transactions, and about reserve currency status, the store of value, where countries hold currency to actually as a claim on other countries. To the extent that banking is mentioned in the book, it's really concerned with the former, about branch banking and allowing banks to settle transactions in their own countries outside its own borders. But what I want to do is to try and also address Harold's question, also the point that Barry raises in the final chapter, which is about some catastrophic collapse of the dollar, where suddenly confidence ebbs away, and then we have a precipitous run from the dollar. And what I want to argue is that that's actually going to be somewhat unlikely given the current nature of banking. But given time, that may also change. Let me show you this chart, which is a chart that shows you the flight to safety. So when you have a ripple in the market, you quite often hear commentators saying, there's been a flight to safety, everyone's running to the dollar. This is for Korea. This is capital flows in and out of Korea. The red bars give you the inflows and outflows of bank debt, and the blue bars are the equity inflows and outflows. And the yellow squares, that's the exchange rate. There's a number of Korean won per dollar. So if that shoots up, that means that there's a collapse of the Korean dollar. There's a collapse of the Korean won and a huge increase in the value of the dollar. And you see that that huge red bar in October of 2008, this was, of course, the month following the bankruptcy of Lehman Brothers, when the world financial system was thrown into turmoil. And you had a huge run from risk. There was a flight to safety, overall flight to safety. Banks were so-called deleveraging. They were shedding risks and paying back their debt. And that's manifested here as this huge negative red bars, in the sense that capital was flowing from the banking system in Korea outside. Now, where it was flowing to, I think, is an interesting question. We need to actually do the detective work and see where it's flowing to. But notice how the dollar is strengthening, how the Korean won is collapsing with that. So whenever there's a flight to safety, the dollar strengthens. And this is somewhat paradoxical if you think about it, because as Barry very, very clearly points out in his book, the US is the biggest debtor country in the world. And the US is the biggest debtor by a very, very big margin. Half of all US public debt is held by foreigners, mostly by foreign central banks. And yet, why should it be the recipient of flight to safety flows? And that's a very reasonable question, because we think, well, if you're very highly indebted, you're hardly the safest credit out there. So why should it be that whenever we have a crisis, there's a flight to safety into US dollars? And the answer is that the US dollar really is the currency that underpins global banking. And what that means is every bank out there borrows in US dollars and uses US dollars in what they do. They deploy US dollars in everything else they do. So they borrow here and they deploy it elsewhere. So whenever you have a boom, they borrow in dollars. So this is a chart that shows you what the foreign bank branches do in the U.S. And what it does is it's a net claim of foreign bank branches on their home office. So the home office sends some money here to the branch, and then the branch sends money to the home office, and this gives you the net claim of the branch on the home office. So think of a negative number there as home office sending money here, and a positive number is the branch sending money to home office. Now this used to be negative, and this is negative for most countries for the US until 1999. And then it goes positive, and it goes hugely positive. So what this means is all the European banks, Japanese banks, all the foreign banks are borrowing dollars, and they're shipping it to their home office. And from the home office, they're making securities purchases in US mortgage-backed securities, but they're also lending it out to their home market as well. And they're actually lending it out to other borrowers too. So in Korea, for example, one of the things that I learned while I was there last year was that half of the dollar loans made to Korean borrowers are made by European banks. So that was really surprising. And that's actually not surprising if you see this chart, which is that European banks borrow in dollars, they ship it to the home office, and they lend it out. Now, this matters because it means that US monetary policy has a direct impact on global liquidity. So if US interest rates are very low and liquidity is very plentiful here, this is going to make an impact globally through the banking sector. So banks are going to borrow here and then lend out. And for example, this is why there is such an outcry against QE2, quantitative easing 2, for example, because emerging markets accuse the US of exporting loose monetary policy and blowing up bubbles in the home economy. And there's always this puzzle that Paul Krugman has always raised, which is why is it that although the subprime crisis happened here, there was also a housing bubble in Europe? Well, actually, if you think about what the banking system does, it actually transmits that liquidity through the bank's own portfolio choices. So at the margin, if it's a matter of lending out to a European borrower versus buying a US security, well, at the margin, the profits and losses have to match. And so when funding is plentiful, more and more of the European borrowers are going to get funding as well. But of course, this actually feeds directly into the global political economy debate, because one of the costs of this exorbitant privilege is that what you do has a global impact. And if your monetary policy has an impact on the globe, you're going to come under a lot of pressure, especially through the much more sort of balanced multilateral fora such as the G20. And there you're going to come under concerted attack. You will actually have much more robust debate at those tables, and also countries are going to take defensive measures unilaterally too, to the extent that they don't have leverage over US monetary policy. They will have to put up defenses against some of the excess liquidity that comes on to their shores. And this, in some ways, will hasten this fragmentation that Barry refers to of the currencies becoming multipolar, and where there is going to be less and less dependence on the US dollar. So I think until we actually have that fragmentation, I don't think this precipitous collapse is likely, given the role that the US dollar has played in the global banking system. You can see that this has hardly budged since the crisis. The second increase, of course, is due to the Fed's liquidity injections. Most of the, in fact, when the Fed announced the recipients of the liquidity injections last year, it turned out that 7 of the top 10 banks that received the funding were actually European banks. And that's all the funding that goes to the foreign banks there. But eventually, if this regime were to change, then I think the kind of multipolar transition that Barry refers to may be a possibility. But I think it's as Harold was saying, it seems very difficult to imagine what the alternative might be and how this transition might take place. But of course, our ability to imagine should not be a guide to what will happen in the future, because I think very few of us imagined what the recent crisis might look like. I think 5 years ago, very few of us would have imagined that. So So I think we should probably be a bit more modest about what our imaginations tell us about what will actually happen. So let me finish that.
John Ikenberry.
Well, I'm the non-expert here, and nonetheless, Barry's book is a big book with big issues at stake, and they are issues that intersect with the study of international relations, American foreign policy, and the rise and decline of international order. So in many ways, the broader debates that some of us are engaged in about whether American power and the post-American world resonate with the kinds of issues that the monetary substructure and its logic and changing nature brings to the fore as Barry provides his account. It is a wonderful and engaging history of the rise and evolution of the post-war dollar system. As with his other work, it's penetrating, it's historically rich, it's elegant, and at times it's even witty. And I think it's very hard to be witty about monetary affairs, but he does so in a very nice way, and at various moments he provides portraits of various figures who are part of this drama of this really 50-year period. Barry argues that a bundle of U.S. characteristics propelled the dollar to preeminence. I think four are emphasized: economic size, financial depth, political stability, and somewhat less specified geopolitical heft, the U.S. larger position. He argues that what he calls advantages of incumbency and weaknesses of rivals, which we're talking about now, keep the dollar on top. But he then at the end says there is shift in power. We're moving towards a more multipolar system in terms of power and wealth, and so we need to think about alternatives, an evolution away from the dollar. Not sure how it's going to occur. It could be a crisis, or it could be evolutionary. It could be towards a composite kind of currency, or towards a kind of hub system where you have different countries that are kind of leaders in either geographical or other kinds of spaces. One of the nice contributions of the book is that at various moments Barry stops and from his historical account and reflects on what he's just said and its implications for current debates. So, for example, he talks about the rise of Japanese economic size during the 60s, 70s, and 80s to as high as 60% of the U.S. GNP. And so there was the question then about the yen and whether it would be internationalized, what would be the role in the monetary system of a much larger and now second largest Japanese economy. Issue about internationalization of the yen was debated. One of our own PhDs, Bill Grimes, has written a detailed account of the internal debates on that inside of the official circles in Tokyo. But there was a decision not to internationalize, and part of it had to do with, as Barry suggests, the advantages that come from a trade-oriented development strategy that was facilitated by the yen's position in the dollar system. And so one can then, as Barry does, reflect in passing about what parallels there might be for China. And here one might go beyond Barry and really ask him questions about how far you would take this parallel. Does China and its own, in some sense, even more profoundly embedded trade-oriented development strategy tied to a particular capitalist authoritarian system, how does all of that package, in some sense, incline China, if it does, towards operating inside of a dollar system that allows it to gain advantages from the position of its non-internationalized currency? So there are issues about parallels and lessons, and those are nicely brought to the fore in the book. I have several questions to ask Barry about the arguments that he makes, and I'll just divide them in two questions really about the geopolitics and politics really of the rise of the dollar and what that then says about what we should be looking for in terms of change going forward, and then some questions about what would the decline of the dollar mean for American power and influence? And that's not unpacked very much in the book, but I wanted to suggest some ideas and see what he thinks. There are glimmerings in the book that the story of the rise of the dollar before, but certainly after World War II, was part of a larger project of building a post-war international system. But the book shies away from moving too far in this direction by arguing, as it does, that there were important functional arguments for the role of the dollar that were, in some sense, inherent in the nature of American power, the size of the economy, the liquidity of the financial markets, the security structure that was around in post-war Europe and in Asia. And so the world, in some sense, gravitated to the dollar. But at other moments, stories tell you that there's more going on there, that there were, and this is where I would ask him, were there larger bargains, even grand bargains, that were part of the construction of the dollar system? And here you, of course, want to think about Germany and Japan and the various bargains that various figures have talked about. The first, of course, being a bargain where the U.S. gets to enjoy the benefits of the reserve currency country, but restraints that it signals to its partners that it will not exploit those advantages. Specifically, the U.S. would not, beyond a certain extent, inflate the dollar to reduce its debt to foreigners, that it would restrain itself. Yes, there would be advantages. Yes, there would be more autonomy and options associated with balance of payments problems, but it would keep it, for the most part, within bounds, and in return, countries would hold dollars and operate within the logic of that system. That's a fairly sort of first-level set of bargains that are mostly about the monetary system itself. But a broader set of bargains that might be arrayed on top or around that, bargains where we talk about security and the basing of troops and the forward deployment of American military in Europe and Asia, and the story of the bargain, but also the insistence, often seen at various moments, kind of coming to the surface, that it's not just all a kind of functional logic, but there are pressure points and there are understandings that the U.S. is conveying to Germany and Japan about holding dollars and accepting some of the costs of adjustment as various dramas unfold, and in return, the U.S. provides this larger set of public goods, not just economic public goods, but broader public goods. So then you start to ask, to what extent is this really a functional logic, public goods, and to what extent really is there a broader set of agreements that crystallized and now we can see starting to somewhat come apart? Was the dollar system embedded in a more general hegemonic bargain, as suggested by figures such as Gilpin and Kaleo and Kirshner and Jerry Cohen, the U.S. providing security, supporting open markets, engaging in responsible rule supervision, and Europe and Japan acquiescing in the American leadership position, even its dominance, agreeing to help finance U.S. balance of payments deficits and operate inside the alliance system. So again, the question is, how explicit were these bargains? How crucial were they for the dollar's role? The other big question is really about the future and about what happens if it does happen. The dollar loses its key currency position. What will be the impact on U.S. foreign policy and general U.S. presence in the global system? Barry talks a little bit about this at the end and tends to argue, I think, that, well, it's the underlying economic strength of the country that really matters. After all, the thesis of the book is that it's not that the role of the dollar gave the American system tools to become powerful, but the U.S. system, in those four ways I mentioned earlier, made the U.S. powerful, and therefore the dollar rose and reflected that underlying strength. And so, in some sense, the answer there is that it all depends on the dollar. The dollar depends on the underlying strength of the economy, whether the U.S. can solve its economic problems and continue to have a kind of robust system going forward. But if the dollar loses its position, it seems to me Barry would want to ask more explicitly what the implications would be for U.S. power and foreign policy. And it seems like my list would be three impacts. I'll call them the Hirschman impact, the Paul Kennedy impact, and the Kindleberger impact. The first one is really about the loss of political stakeholders. States that use the dollar develop vested interests in the value and stability of the dollar. They're not simply economic partners, but they are, in some sense, dealt into a larger system that they have a stake in. As Hirschman argues, political logics grow up around those economic dependencies, and stakeholder politics ensues. The fate of the dollar and the U.S. economic health becomes a generalized interest within the international system. And so the question is, as I think Hirschman would ask the question, with the decline of the dollar, would those vested interests start to disappear, a kind of unraveling that's broader than simply the shift in the monetary system? The Paul Kennedy effect, the U.S. would lose balance of payments flexibility. It would need to tighten its belt. It would need to be able to, it would have a harder time borrowing and consuming above its level of production. Guns and butter debates would be more explicit. Now, of course, you can always solve your problems with cutting other kinds of outlays, but the question is, in a political system, in a democracy, how will commitments, geopolitical commitments, fare in this world where the U.S. is more constricted in its fiscal policy? This suggests there would be growing pressure to engage in geopolitical retrenchment, and there would be these broader effects in the overall position, which in turn could accelerate decisions by holders of dollars who may already have buyer's remorse to think the unthinkable and move towards other kinds of arrangements for currency. The third impact, potential impact, the diminished dollar would have an effect on crisis dynamics. Today, as we've just heard, financial crises tend to in a kind of puzzling way, even though the U.S. may be the trigger of the crisis and the U.S. is a debtor country, the dollar is the beneficiary of that crisis, the flight to safety. What happens in a world where you have a multipolar monetary system? Will that effect actually cut the other way? Will a crisis, particularly let's say a military crisis where the U.S. is in some sense igniting the crisis, to what extent, and if it happens, there's a flight away from the dollar, how would this then impact both before the crisis logic and strategy, and after the crisis policy options, what the U.S. would do? The U.S. would have less macroeconomic autonomy, U.S. leadership options would decline. So Barry, in conclusion, Barry's book illuminates the world monetary landscape and helps us provide a framework for debate about the future, and because of that, it's a quite successful book. Thank you.
Okay, we'll hear from Barry.
I'll try to be brief because I think the fun part will be the Q&A and the interaction among the panelists. But let me acknowledge how nice it is to be here in this room, in this school, in this university, where people like Fritz Machlup and Bill Branson and Peter Kennan, who's with us this afternoon, have contributed importantly to the literature that we're discussing at a book forum. Thank you to Mark and the Cyril Black family and the other institutions. It warms the cockles of an author's heart to still have a book forum in the 20th century, although the format is a little bit what I assume on the part of my students. Assuming that you've already read the book, we can launch immediately into discussion of it. And the particular format prevents me from doing what I've made a career of doing, talking about history when I'm among economists. talking about economics when I'm among political scientists. So you got me on that one. And if the book is timely, it is timely only because there are always concerns about the dollar. The point, as you've heard, is the extraordinary dependence of the global monetary and financial system on the US dollar. So the Bank for International Settlements just released its latest triannual survey of foreign exchange trading. And for a country picked entirely at random, South Korea, 99% of South Korea's foreign exchange transactions are purchases and sales of won for dollars. 99% of Chile's foreign exchange transactions are purchases and sales of pesos for dollars. So they have an FTA, and the number one selling wine in South Korea is Montes Alpha. But when a Korean wholesaler wants to import it, he doesn't buy Chilean pesos, he buys dollars in order to use them to pay the Chilean exporter who converts them into pesos. So it's a remarkably dollar-centric world. I use in the book the examples of when Somali pirates ransom a ship, they demand that the ransom money be parachuted to them in dollars. When Mr. Karzai's people give him bags full of money, the bags are full of dollars, or so we're led to believe. One of my arguments in the book is that the tension between what is still a remarkably dollar-centric world and an increasing dollar-centric monetary and financial world, and which is in other respects an increasingly multipolar globe, both economically and politically, is one way of understanding that the tensions and instabilities that we've recently experienced. It was one factor in the global economic and financial crisis, the fact that when we in the United States indulged in financial excesses and reckless real estate speculation, foreigners gave us more rope because they had this extraordinary appetite for dollar-denominated securities. And as young Shin mentioned, the fact that the global financial and banking system are so dollar-based gives the Fed leverage that it doesn't entirely want sometimes over the operation of other people's financial systems. So I, optimist that I am still of the view that this will change and that we will move toward a more multipolar global monetary and financial system where there will be three big economies or economic blocks, one the United States, the Euro area, and China, and all of their currencies, say 10 years from now, will play consequential international roles. So Young gave us kind of, at least implicitly, the argument for why that might not occur. He gave you a version of the strongly increasing returns argument, where banks all fund their business in dollars because all the other banks fund their business in dollars. And it's simply too expensive to do otherwise. That's the advantage of incumbency that I think Harold may have referred to in another guise. So I make the general argument in the book that if this was true once upon a time, which is arguable because we have in fact seen international monetary and financial systems where more than one currency played consequential international roles, kind of hinting at the fact that these strongly increasing returns may have their limits or they may not explain everything. I argue, be that as it may, this feature of the global monetary and financial system is unlikely to prevail in the future. I arc back to the presumption we used to have about operating systems for personal computers, that there was only room in the market for one because network increasing returns were so strong. If you wanted to exchange data with, if you were anything other than a computer hobbyist, you had to use Windows. And we've learned that technology adapts and switching costs are not always and everywhere that high, even when there are network kind of interactions. where it might pay to do the same thing that other people do. There are other considerations. You may not like Microsoft, or you may not want to put all your eggs in the dollar basket, and you may begin to look around more actively for other currencies in which to fund your lending operations. So the evolutionary story would be, over time, these European banks begin to look to other places to fund part of their operations. The advantage that the dollar has had historically, and still has to an extent, is twofold, I think, as we heard. The language I would use is markets and dollars are incredibly liquid. The US Treasury market is the single most liquid financial market in the world, and that makes it attractive for people to do business in dollars. That's one of the two characteristics of the dollar that make it the safe haven. People fled to the dollar, quite ironically, unfairly in the European view, for example, after Lehman Brothers, because one of the most valuable things you can have in a period of turbulence is liquidity. And the dollar has that. It will take time for the Europeans to build a liquid Euro area-wide bond market, although e-bonds will be the seed from which that tree will grow, I think. And it will take the Chinese even longer to do that. But the second thing that the safe haven currency has to have is stability. And that's where I think people wonder about whether the dollar will continue to possess that characteristic. They will look around for alternatives, and if they see that the markets in dollar-denominated assets don't display the stability that they require in a safe haven currency, they will, that will increasingly create room for alternatives. We've heard, I think, about the two scenarios that I paint for how this transition might occur. It might occur smoothly or not. If it occurs in a smooth evolutionary fashion, and there has been, international currency status has multiple dimensions. Along some dimensions, we have begun to see this smooth transition. So the share of the foreign exchange reserves of central banks and governments around the world has been falling very gradually in recent years as the Russian central bank has been buying Canadian dollars and Australian dollars and other things to slowly supplement its dollar reserves on the margin. In terms of other characteristics like foreign exchange trading, clearly there has been no progress to date, although that doesn't preclude the same kind of slow evolutionary movement over time. I forced myself in the final chapter of the book to think about disaster scenarios and contemplated three. I thought about the possibility that the Chinese would dump their dollars and concluded that that would hurt them more than, at least as much as it would hurt us from a purely financial point of view. I contemplated the possibility of a geopolitical spat comparable to the 1956 Suez crisis. I don't know, in the South China Sea. There are some scenarios there one could think about. And again, I concluded that the circumstances today are very different than they were, say, in 1956. The US was so large economically and financially relative to Britain that we could credibly threaten Britain with, we will deny you access to an IMF loan. We will sell our sterling reserves without hurting ourselves in the United States, because the UK export market was not important to us. Our holdings of sterling were not important to us. The Chinese are still a smaller, much smaller economy than the US, and that weapon would backfire to an extent if they tried to use it, I think, to advance their own geopolitical goals, or at least the fact that there would be significant costs to China would cause them to pause. So the only plausible scenario for a dollar crash, in my view, is one where we do it to ourselves, where failure to address our medium-term fiscal challenges, begin to demoralize foreign investors and dollars, polarized dysfunctional politics in the United States extending for a period of years, begin to demoralize foreign holders of dollars. So when I wrote the book, I optimistically said we have about 5 years to get our act together in the United States. Now I've been giving book talks, and I realize I can sell more books if I say financial crises almost always occur around the time of elections. So you can do your elections. You can do your arithmetic. Finally, John asked about implications for and impacts on U.S. foreign policy. And I tried hard to think about that. I would reiterate what John accurately said, that it's fundamentally the health and strength and productivity of the U.S. economy on which our foreign policy leverage hinges. And the fact that we have the exorbitant privilege of living beyond our means. We can sell more low interest rate debt to foreigners than we would be able to otherwise because we have the privilege that the dollar is not only our currency but the world's. That gives us modestly more resources than we would have otherwise to build radio Free America transmitters around the world or station troops in Iraq and Afghanistan and pay them. But you know, that's small potatoes, if you will, compared to the larger issue of maintaining the health and productivity of the U.S. economy, and which is the thing that has the first order implications for U.S. foreign policy. But I do write toward the end of the book that a world in which the dollar loses its exorbitant privilege would be one in which the dollar exchange rate was weaker than otherwise. Our dollars would go less far in terms of supporting foreign policy initiatives, sending a new generation of Peace Corps volunteers abroad, U.S. doctors abroad, whatever your soft power, hard power, whatever. So I think that's really where the implications for foreign policy lie. John asked also about whether there is potentially a crisis problem associated with a multipolar global economic and financial system. Would Charles Kindleberger be alarmed by the prospect of such a system? I think there are risks, but they derive fundamentally from reckless policies on the part of one or more of the reserve currency issuing countries. If there were such reckless policies, then you could have a sudden shift from one of these currencies to another. Exchange rates would move suddenly. Important institutional investors would be wrong-footed, and bad things could happen. The other side of the coin, if you will, is that this kind of system would be a source of more discipline on the governments and central banks of the reserve issuing countries than otherwise. They would get early warnings when policy showed signs of going off track, and maybe they would take them to heart. So where I come out on this is that I don't see such a system necessarily being an engine of instability. If it were coupled, as Mr. Sarkozy suggested in August of last year, with a new system of target zones, an attempt to stabilize the exchange rates between the dollar and the euro and the renminbi, then I'd be alarmed, because I don't think such a commitment would be credible. I think it would quickly come unraveled, potentially in a violent manner. So I'm happy that Mr. Sarkozy, now that France has taken over from Korea the presidency of the G20, has been backpedaling as quickly as possible away from those ambitious proposals and talking about a multipolar international monetary and financial world. Thank you.
Okay, we have about 25 minutes for questions from the floor. Sophie.
First of all, thank you. This is really a great panel and a great format, so thanks for organizing it. I'd like to follow up exactly on your last point. Of course.
I thought you might.
So France is the president of the G8 and the G20 this year, and has announced that reforming the international monetary system and ending the exorbitant privilege of the dollar would actually be its main goal for that presidency. And as you can imagine, the French have been pretty busy trying to reassure American officials that this was not another typical French full frontal attack against the US, but it was actually in the interest of the US, what they were doing, that trying to reform this in a concerted, coordinated manner was to the benefit of the Americans. So I'd like to have your take on this, I mean all of you actually, and see whether actually the French are right that they're helping the US instead of attacking them.
Anyone want to tackle that? All right.
Well, to tackle it, one would have to know more about the content of the French reform proposals. To be fair, it's early in the year. So to criticize the French by saying we don't know what their ideas are yet would not be entirely fair. What a fair criticism would be the single most important thing the French can do to strengthen the international monetary and financial system is fix the problems in the euro area. I don't know if I should go on.
Okay. Yes.
How would a global trade war affect the role of the dollar? In other words, if you've got rising protectionism around the world because of rising unemployment among the industrialized nations, and then protectionism started to increase and there were higher and higher tariffs culminating in a trade war, how would that affect the dollar as a reserve currency?
Well, I think the scenario you paint, which is one people were worried about with good reason in 2008, would not be good for the world economy. It would not be good for global growth. I don't think it would necessarily have first-order implications for the dollar, to the extent that it would be another series of negative shocks to the world economy. Financial markets would respond badly. You would again get the flight to safety kind of safe haven effect benefiting the dollar in the short run. It certainly wouldn't make for the kind of international cooperation and dialogue we're going to need in order to make progress on this issue.
Yes.
What would the role be or status of precious metals like gold and silver today and in a disaster situation such as you might predict?
Anyone want to address that? Okay.
I told Harold at lunch, I do get, having worked on the gold standard, I do get asked about the prospects for gold from time to time. And now I say, I've been predicting significantly weaker gold prices for 10 years, and I'll keep predicting them until it is quite remarkable fact how high gold prices have gone, and how even central banks that had been quietly selling gold on the margin over a period of many decades now, some of them, like the Reserve Bank of India, Bangladesh, I think a few others, have begun buying again. Stubborn as I am, I think this reflects the really extraordinary environment we're in which no financial asset is paying a reasonable return. No financial asset that a central bank could buy is paying a reasonable return at the moment. Interest rates are zero everywhere. So in those circumstances, central banks, like others, look for something else. Someday, economists, I am confident, interest rates will return to more normal levels. And that suggests to me that the historical trend in which gold has, over the course of the last century, progressively played a smaller and smaller role in the international and financial system will resume.
I think Harold has something he wants to add on this.
I don't disagree with what Barry has said, but it seems to me there are two aspects of this issue. One is, does gold have a future in the international monetary system? And it seems to me that the answer to that question is really very definitively no. But the other question is gold something that people will look to, central banks as well sometimes, but above all, private investors in times of worries about inflation. And I think this is exactly what is going on at the moment, that it's an asset, and you can think of other assets like this, but many commodities are doing the same thing. But you could also think of collectible postage stamps. All these sort of things indicate a fundamental nervousness about the existing currencies in every major country. And that's actually a cause of potential instability. I mean, I think when we're thinking about the geopolitics of this, you really have to think of the effect that price rises have on people who are poor, who don't have good access to food or water. And whether it's China or whether it's Egypt, this is a tremendous possible source of social explosion.
Yes.
What role do you think American financial innovation has historically had in the markets? And do you think, how much of current doubt do you think is being driven by the recent financial crisis?
Where to start? Certainly, financial innovation supported by public policy was very important in the dollar's acquisition of its international currency role. So one of the things I argue in the book is this didn't exactly come about naturally. In 1914, the U.S. was already far and away the largest economy in the world. We had overtaken Britain as the leading exporter in the world, and yet the dollar played no international role whatsoever. 0% of global reserves were in dollars. 0% of trade credit for imports and exports was in dollars. American exporters had to go to London to get trade credit in sterling, and financial innovation changed that. So financial innovation in the form of the growth of market and securitized trade credits. They weren't called CDOs, but they were called trade acceptances. They had a lot of similarities, and it was in part to promote the development of that market and internationalize the dollar that the Fed was founded in 1914. The Fed jump-started that market. And that's why I believe China will now move successfully and rapidly in internationalizing its own currency. That's what they're trying to emulate that example. So you will have noticed last month that you could open a renminbi-denominated bank account in New York at the state-linked Bank of China. That they're allowing 70,000 companies to do their cross-border trade settlements in China's own currency, like Paul Warburg and Benjamin Strong and Nelson Aldrich in 1914. Chinese officials today think it's a considerable advantage to your companies and your banks competing for business to be able to do that business in their own currency. So that's why we promoted this financial innovation in 1914, and I think that's why the Chinese are doing it now. So more broadly, I guess a lot of the book is about the interplay between financial innovation and financial policy. What do I think the role of the crisis was? I actually, it's almost embarrassing to acknowledge, published a column and op-ed piece in the Financial Times in early September of 2007. So the subprime crisis had erupted. Some important investment funds had failed in August. And I suggested that this would accelerate the movement away from the dollar because it would undermine the confidence on the part of foreigners that the U.S. government could be trusted to be a good steward of its currency, and of course the safe haven effect that we have been discussing moved in the other direction. So that's a reminder not to base your investment decisions on anything you hear in a seminar or reading the FT. But I do think as foreign central banks, governments, and private investors absorb over time the implications of this crisis, and they are reminded of how political and politicized regulatory policy, for example, can be in the United States. They won't want to hold all their eggs in one basket, and that will continue. I don't know if I want to say accelerate, but continue to, that lesson of history will continue to lend momentum to the gradual diversification away from the dollar.
Yes.
Can you talk a little bit about the whole quantitative easing policy, especially about the whole thing, the negative foreign reaction to it, which seems to be unsettling, changing, and how that's going to impact the whole role of the dollar?
Right. So I don't know how much I can add to what Hyun Shin said before. There are a variety of channels through which the Fed's policy of quantitative easing, which, my amateur opinion would be was and is entirely appropriate for the United States, creates difficulties for other countries. They do at the moment continue to fund much of the operation of their financial systems in dollars. Many of them continue to at least shadow the dollar, keep their currencies quite stable against the dollar, which means in a world of open capital markets that their interest rates can be very much different from ours. So, a level of interest rates that is appropriate for the U.S. is not appropriate for them. That's all you need to know, except you also don't know the answer to the question, what should we be doing about it? I don't think the Fed should be doing anything about it. I think the Fed should be following its dual mandate and doing what's right for the U.S. And foreign central banks and governments in the short run ought to be using tightening bank regulation and using market-friendly capital controls to limit the impact on their financial systems and economies of these inflows. And letting their currencies rise can help with that. That loosens the link potentially between our interest rates and theirs. And in the longer run, it's another argument for thinking maybe we shouldn't allow our financial systems to remain as dollar-based as they are. Would we rather have Mr. Bernanke running our monetary policy if we are Brazil or China? Or is it better to let a selection of central bankers from countries where economic conditions may be rather different be responsible for setting the overall level of conditions?
Yes.
If we were to move towards a composite currency, what do you think the prospects would be for the SDR? Or do you think the concept would need to be more broad-based in that?
So I'm an SDR skeptic. I'm way far out there on that end of the opinion spectrum. There are other people in this room who are more positive about the scope for special drawing rights. So I certainly think, well, put it this way, there once upon a time there was a period when the SDR was more broad-based. In the early 1980s, I think there were 16 currencies in the SDR basket, and the conclusion was reached that this unit is so complicated, there are so many components that it's not attractive for international use. So we simplified from 16 to 4. And now there's talk about going back from 4 to 16. I guess I draw the conclusion that the particular composition of the basket maybe is not the biggest of all issues, but rather that if private investors want a basket, they can roll their own. And central banks are not going to find a basket-based unit terribly attractive unless they can use it for private market intervention, which they can't unless those private markets exist. The other reason I'm skeptical about SDRs is that when there is a liquidity problem, when there is a financial crisis, you need the issuers of the reserve currencies to be able to provide more to banks, private and public, in distress. So the Fed famously provided those 4 $30 billion swaps after Lehman Brothers. In the world I imagine 10 years from now, the Fed and the ECB and the People's Bank would be doing those kind of things for countries whose banks did business in their currencies. Now ask yourself about the SDR. Would we authorize the International Monetary Fund to act like a true, independent, global lender of last resort? Are we ready for a global central bank where Mr. Strauss-Kahn can decide over a weekend how many billions or trillions of SDRs to create because, in his opinion, the global financial system needs them? The answer is no. We're not going to have a global, Mr. Bernanke is still accountable to Ron Paul. There still is a Congress to which the Fed is accountable. The IMF is not, directly accountable to national congresses and parliaments in the same way. So I think, we're far away from that. Therefore, we're far away from a world where the SDR plays more than an incrementally more important role than it does today.
Okay, last question. Yep.
One of your 4 pillars here is economic strength of the U.S., but certainly I agree with those 4 pillars. You look at something like the political stability and worry about Sarah Palin, but that's another story. But the economic strength seems to be based in the U.S. We've given away so much of our manufacturing sector. And I think we've given it away. I don't think Germany has done it in the same way. I don't think Canada has. But we've given it away on the basis of what I think is a voodoo global economic theory that countries like China are more efficient at doing things. And they are efficient in certain ways, but not as efficient as we've allowed them to be by manipulating currency, by environmental degradations, by subsidy of critical industries. And we just let countries like that get away with it. I don't know how long the U.S. can survive in a strong position when we're giving away our manufacturing.
I can't resist observing that I quote Sarah Palin in the book, who has held forth on the international role of the dollar on her Facebook page. Her entry was fewer than 140 characters, however, on my fine. I think Mr. Obama gave a stirring speech a few weeks ago about what needs to be done to enhance the competitiveness of the U.S. economy and increase the vigor of our manufacturing base and its international competitiveness. He neglected to explain, probably he was out of time, how we're going to pay for it. But I think his diagnosis was right, and I would relate it to the argument of my book in the following way. There's some people who think we can depreciate our way out of this problem. By devaluing the dollar, we can restore the competitiveness of U.S. manufacturing. So Clyde Pretzowitz has written a book to that effect. My friend and Peterson Institute colleague Fred Bergston sometimes argues along those lines. I think a weaker dollar will help modestly on the margin, but Obama pointed to investing in training of workers, education of the labor force, the need for infrastructure for firms that want to get their goods to the ports and on the boat, more investment in plant and equipment. And I don't think a dollar that's 10% higher or lower will really, much diminish the need to do those things. However, the dollar's exorbitant privilege has meant that when we import stuff, we don't have to manufacture other stuff to pay for it entirely. Among the things we can manufacture are treasury bonds, which we can sell to other countries when we import BMWs. We still pay interest on those treasury bonds, but modestly less than we would otherwise. So the dollar losing, or more realistically sharing its exorbitant privilege with other currencies, would mean a somewhat weaker dollar, a shift away from a financialized U.S. economy where we export pieces of paper, and back toward a somewhat more manufacturing-based U.S. economy. So I do think there's a role for this rebalancing of the financial system. I think there's a role for a modestly weaker dollar exchange rate as part of this adjustment, but fundamentally, whether the economy succeeds or fails at completing this task will depend on whether we do these other things: training, education, infrastructure, capital formation, et cetera.
Peter?
Barry, I have, read your book, and I congratulate you on a superb job of analysis and exposition. One thing I'm curious about, I have not looked at the latest BIS triennial survey of foreign exchange markets, but I will bet you dollars to SDRs that there has been very little reduction in the role of the dollar as essentially the vehicle currency in foreign exchange trading. And I would suggest that if you ask yourself how an international monetary system is built, the functioning of the forex market, what more than the functioning of the bond markets, is the starting point. And the stability of the structure of that market seems to me to have been quite impressive over the last several decades. That's more of a statement than a question, but I'm ready to comment.
So I think the statement is exactly correct, that there has been no movement between the previous BIS survey 3 years ago and this one.
That saves me the need to read it. Thank you.
But the issue is how much technology may now change that. So we've been in a world where foreign exchange trading was over the counter, where people met at the counter, and on one side of the counter were people with green pieces of paper, greenbacks, and everything almost went through the dollar. It's much less costly technically to set up an exchange between many currencies, or it should be less costly now than in the past to trade Korean won for Chilean pesos for purely technical reasons. So I conjecture about what might happen in the future, but I acknowledge your point that there's no sign of it happening yet.
Okay, well, I just want to give our panelists a really quick moment to respond to what they've heard. They don't have to give us a big elaboration of things, but Harold.
Two very quick sound bites. One is the exorbitant privilege. Is it that much of a unique privilege of the United States? Really it isn't, because a lot of other countries manage to borrow in their own currencies and finance big current account deficits. So in a sense, the US story is just a larger version of what, say, the UK or Ireland did. Now, some of those countries are unraveling in a spectacular way, but many countries are still running current account deficits, including the UK, Spain, etc., and the United States. And the second soundbite was really triggered by the question on the trade war and economic nationalism, and your comment that Mr. Bernanke has to be responsible to Ron Paul. Is this a danger for your world, in that exactly the story that we were talking about, that Hyun had very prominently in his presentation about the swaps after 2008, and then the anger in Congress already in the summer of 2009 when Congressman Grayson quizzed Bernanke about the New Zealand swaps. Isn't this going to change, if it goes on and on and on, the way in which the Federal Reserve operates and the way in which the banking system then operates?
I hate to have the last word in front of the speaker, but I think it's, there is something in addition to merely being able to borrow in your own currency, in that although the US is the biggest debtor country in absolute terms, it is the biggest creditor country in the banking system. And I think that's the privilege that that carries with it the big burden of responsibility in the way it conducts itself. I think the fact that the Fed has come under a lot of attack really reflects, and I think that's something that's pretty unique. And there was a question earlier about financial innovation and what the prospect of the role of the dollar is with the waxing and waning of that. And in a way, the predominant role of the US dollar in the banking system has come from the fact that the US developed this very innovative market-based financial system where foreigners can come and borrow and actually and use that funding everywhere. And to the extent that the financialization will then turn the corner, actually perhaps diminish and have a smaller role in the economy, that role will diminish as well. But I think that's really the open question. To what extent do we expect the financial system, the financialization of the economy, to diminish, or will it just carry on, or will it perhaps have an even bigger impact? So I think that's the open question that I'd like to end with.
So I want to thank our panelists for their extraordinarily intelligent dissection of this book. Actually, John Ikenberry had to leave, but I also want to thank Barry for coming here to Princeton to talk about his new book. This is an excellent book. I'll hold it up here. You can buy copies of it outside. It's, as was said earlier, it is witty, very readable, important, timely. I think you will enjoy it. So we will have a reception outside, and you're welcome to join us.
Good. Very good.
I learned some things from the panel.